Joining us more now is Mike Hunstead, CIO of Northern Trust Asset Management. Mike, good to catch up with you. Thanks for joining us here at AusBiz. We are at that time of year, of course, where we look forward to 2025. The question for investors is, can the bullishness we've seen in US equities, the momentum, continue into next year?
Yeah, I think we have a great macroeconomic backdrop behind us in terms of growth being fairly stable, inflation being relatively under control. I think we have a great valuation profile, despite the fact that, on paper, it looks like U.S. equities are a little more expensive than they have been in the past. But you have to consider that the sector composition of the benchmark looks a lot different than it did before. So I think that explains a big piece of it. But also, when we look at how profitable companies are, and it's not just earnings, it's profitability, and those are all factored into the equation. By and large, when we look at profit margins in the U.S. right now, about 12.5%, steadily increasing over the last couple of decades. Looking just 2 years forward, we expect that to increase to about 14.5%. That's pretty much in line with consensus. Some of that is AI driven. We expect there to be productivity gains from artificial intelligence. They're going to help that profit margin even further. So when you look at the macro picture, the margin picture, the valuation profile of equities, we're very bullish on equities, U.S. equities in particular, for 2025.
Breaking that down further, Mike, what's your view on those mega caps, which of course have dragged the entire market higher, outperformed this year, certainly compared with the smaller caps?
Yeah, I think there's a lot of room for both mid and small caps to run in 2025. We're not expecting a decline in the Mag 7 prices in the next year, but rather that others will catch up. Small caps have relatively healthy earnings in the U.S. They have a much better valuation profile. The valuation spread between large and small caps is very attractive right now. And with the new political administration coming in, sort of the America First policy, that tends to benefit small caps disproportionately because they source a lot of their revenue domestically. So U.S. small caps, definitely an area that will get a lot of attention in 2025, and for good reason.
What are you seeing more broadly with the US economy at the moment? I see that you're expecting a soft landing. Now, questions in regards to just how many rate cuts the Fed is going to embark on. Expectations they're going to cut again next week. What are you looking across the horizon, though, in terms of just how far it is going to ease?
Yeah. We're a little bit more aggressive in our expectations. So if you look at what the market is discounting currently, everyone agrees December next week, we're going to have a rate cut. Looking into 2025, the futures market looks about 2-ish in terms of rate cut expectations. We actually have 4 on our schedule. So we expect a little bit more aggressive cuts. We think inflation will come under much better control in early 2025. That will prompt the Fed to be a bit more aggressive in their cutting pattern. So unambiguously, rates are going down, at least on the short end of the curve. I think on the longer end, it's a different story.
So we take a look at how the US economy has performed, particularly relative to Europe, for instance. We might get that chart up. Is that expectation likely to continue, particularly, I guess, with the incoming Trump administration? And we talk about I guess certainly tax cuts for a starting point.
Yeah, and on this chart, I think tells an interesting story. So 2009, the Euro area in the United States had about the same nominal GDP. Since that time, there's been a wide divergence, and we expect that to continue. And in fact, this is really a proxy for developed markets ex-US, not just Europe. But when we look at our GDP forecasts, in the US, we're about 2.5% over the next decade. In Europe, relatively anemic 1%. So this gap is going to widen even further. So while we're bullish on US equities, not so much in Europe, not so much for developed markets ex-US, we're actually underweight developed markets ex-US. So a big divergence across the globe in terms of growth expectations. Now, you ask about the incoming Trump administration. From a tax cut perspective, I think it's relatively benign when you look at the personal tax cuts, personal tax rates. Everyone expected those to be extended, and all evidence suggests that they will. I don't think their impact will really be felt. On the corporate side, though, depending on what the actual number pans out to be, whether it's cutting from 21 to 20 or 21 to 15, regardless, our analysts expect a relatively minor impact on earnings as a result, anywhere between 0 and, let's say, 3% at most. When the backdrop of 14% expectations is consensus, that's not a massive number. So I don't think taxes or tax policy will play a huge role going forward in terms of equity prices. But it's certainly something that we have to consider as a risk case. Much more on the supply side with tariffs and immigration. I think that has a much bigger impact than the potential tax policy would be.
Mike, what's your view on emerging markets, I guess, relative to developed markets? And maybe we'll also take a look at China at the same time in your outlook, particularly with the prospect that they'll be, well, we're expecting more stimulus and perhaps monetary easing.
Yeah, we're actually overweight emerging markets in our tactical asset allocation. Now, there's a couple of big things that need to be considered, though. China currently is about 25% of the emerging markets benchmark. And while there has been stimulus in China, we're not really in the camp that it's going to be meaningful enough to really pop GDP to where it has been in the past decade. We've cut our GDP expectation for China significantly going forward. But another consideration, which is highlighted by this graph, is that when you look at the performance of Chinese equities, there's been a big impact of share issuance. So the more shares a firm issues, the more it dilutes its return, its equity return. That has a negative impact on total equity performance. And you can see on this chart that blue line kind of below or pointing down. That indicates over the last decade, Chinese equities have been diluted by about 10% per year. So bled performance of about 10% per year just from share issuance. So a lot more shares going into the market, meaning returns are lower. We don't expect that to cease anytime soon. So while at least from a nominal perspective, GDP still may be in the 3 to 4% range for China, you have to really consider what your actual performance will be by holding Chinese equities. And they're a good value, but we're not going to get back to the double-digit returns that we've seen in Chinese equities, 10, 15, 20 years ago. So we're overweight emerging markets as a whole. Most of it on the back of positive expectations for India and Southeast Asia. China is a relatively good value, but it's also a risk case for us. So a little bit of caution is warranted in emerging market investing.
And Mike, just finally, some thoughts on Australia, particularly as far as what you're seeing for earnings.
Yeah, near term, it's somewhat anemic. We're expecting about 3% earnings growth over the next year. 2 years out, increasing to about 6%. Longer term, though, getting back into the double digits. So not a huge upside in the next 12 months, but over the next decade, it's actually one of our highest performing countries in terms of equity price expectation. So 8% return expectation over the next 10 years. Near term, bogged down by weakness in commodity prices, but over the longer term, a lot of strength. So definitely overweight Australia in our more of our strategic asset allocation.